The Great Recession has forced the Federal Reserve into what we call unconventional monetary policy. The economy really needs to be goosed, but unfortunately nominal interest rates are at 0%, which is as low as we can get them. In response, the Fed has been engaged in quantitative easing and also forward guidance. These are an attempt to lower not just today's interest rates, but also future interest rates. So far, so good. The problem is that people are concerned that unconventional monetary policy may end up having some unconventional costs. We haven't yet had a clear articulation of what these costs are, and so this paper, I think, is the first serious empirical attempt to move from worrying among pundits to actually crunching data to try and figure out whether there are important costs to unconventional monetary policy. Here's the cost people are worried about. They're worried about if you push interest rates down to zero, then folks who are running money market funds or defined benefit pension funds may then want to reach for yield. What that means is that they may take unnecessary risks in order to actually get a rate of return that's positive on their money. And so the author looks very closely at how the market has responded to various episodes of unconventional monetary policy. There are really two factors to take into account. So one is the risk, which is that people may reach for yield, taking on unnecessary risk. Against that is if unconventional policy works as it should, it's going to improve the economy, and it's therefore going to improve the value of all the assets that these financial companies hold. And it turns out that that latter benefit looks so far as if it's outweighing the potential costs. So the way the authors do this is he looks closely at how the market prices and credit default swap prices around episodes of unconventional monetary policy affected money market funds and defined benefit contribution funds, life insurance companies and the like. And it turns out that each of these episodes of unconventional policy, rather than reducing the value or raising the risk of those organizations, appears to, on average, have slightly increased their value and potentially reduced their risk. The bottom line here is it's very hard to know what the full effects of unconventional monetary policy are. But this, which I think is the best forensic look at the data so far, says markets aren't worried, and in fact, it may actually be helping financial stability rather than undermining it.